Good afternoon, everyone. Welcome to House Economic Matters Committee. Today is February the 17th, 2022, and we're getting ready to start our bill hearings for this afternoon. I would like to remind everyone that you are being videotaped, so please be aware that you're on, somebody's recording you at all times. In addition, for individuals who are participating in this, please note that the chat is only for members, so please do not enter anything in the chat. And also asking that you keep yourself muted until you're asked to unmute, or at that point, you can then unmute. And again, as I've been saying before, understand that once we have this hearing, it's a live ball. So if you have any amendments, anything of that nature, you need to get it in immediately because this bill can be voted on at any time. We have two bills today. We're going to put them together because they have very similar support and opposition. We have Delegate Wells, who's going to speak briefly about her bill, House Bill 436, and then Delegate Jalisi, who's going to speak about his bill, House Bill 690, and they're both basically motor vehicle insurance, use of credit history, and the rating policy. So Delegate Wells, you can go first. Delegate Jalisi, you follow, and then we'll call your witnesses.
Okay, great. Thank you, Mr. Chair, and it's a pleasure to be before you as you preside as chair of this esteemed committee. I'm also just happy to be in front of my colleagues on ECM. For the record, I am Delegate Melissa Wells. I'm here today presenting on House Bill 436. This is a bill to eliminate use of credit history as a penalty for driving uninsured in order to decriminalize poverty in Maryland. So we know the current law states that driving without auto insurance in Maryland is a crime punishable by up to 1 year in jail, a $1,000 fine, or both for the first offense. This also does not take into account, in terms of impact, the $150 fine, as well as the $7 daily insurance lapse fee. And so we know that there is a segment of drivers here in Maryland that do drive without insurance. And a large part of why that does happen in cases is because they cannot afford it, because Maryland allows insurance companies to use credit history when setting rates. And we know the use of these non-driving factors doubles the rates for lower income communities. Bankrate just released a state-by-state analysis on the impact of credit scores and auto insurance, noting Marylanders as a whole pay nearly double for poor credit versus excellent credit. Just give an example, that's $2,935 for poor credit versus $1,565 for excellent credit. The Consumer Federation of America also found that State Farm charged Baltimore drivers with poor credit scores on average as much as 171% more than drivers with excellent credit scores. And that was controlling for all factors, including the driving record. So, as the state does mandate the insurance to drive to work, it's our responsibility to ensure that it's affordable. We know that insurance is definitely necessary and we should have it, but it should be affordable. And credit history is neither a strong indicator of risk nor fair to good drivers with little or no credit history. So for those reasons, I am asking for a favorable report on HB 436. Thank you.
Thank you, Delegate Wells, for your brief recitation. We'll go now to Delegate Jalisi.
Thank you, Mr. Chair, Wilson, Vice Chair Crosby, and the members of the Economic Matters Committee. I come before you to reintroduce a bill that affects every car owner in Maryland. And like Delegate Wells said, we are required to have auto insurance in Maryland, but the auto insurance needs to be affordable. My bill basically deals with linking the auto insurance premiums with a person's credit history or credit worthiness more so than their driving history. I submit to this committee that this is patently unfair to people who may have otherwise perfect payment records and perfect driving records. But for example, things which may not be directly in their control, for example, co-signing a student loan for their child to go to college, which is how I came across this problem, would impact their FICO scores, and unknown to them would also negatively impact the money they pay every month for auto insurance premiums. So my bill specifies that credit history may not be used in any manner to do a risk assessment for whether the person is a good driver and so would be a safe driver or not. And I think also, besides people who have lived in Maryland for a long time, it also is patently unfair to new immigrants who may not have a credit history to begin with. for many, many years after they settle down, after moving from their native lands. And I think by making them pay more just because they don't have credit history also makes it more difficult for them to find suitable employment and be able to drive to work. And I think that the immigrants come to this country to have a better life for themselves, for their families. But we should not be making it difficult for them or for other people who are long-time Marylanders, and penalize them because, like, if they sign their child's a loan or to go to college. So and I know there'll be people who will be coming after me, opposing this, saying that 15 or 20 years ago, there was some deal made with the auto insurance industry, which allows this type of assessment of risk. But in this 21st century, and especially in these days of ongoing COVID pandemic, when a lot of good people who are otherwise financially secure are having trouble finding their ability or finding themselves able to pay sometimes their bills, it puts an extra burden on those Marylanders to have to also pay higher costs in the auto insurance premiums. So for purposes of being equitable, for the purposes of being fair with everyone who has good credit, who has good driving history, but not such a great credit history, I think that this limitation, this requirement for using the FICO scores to calculate the risk, whether somebody is going to be a good driver or not, is unfair. And I request this committee to undo this burdensome requirement and vote for my bill and support it favorably. Thank you very much.
Thank you. And again, we're going to just share witnesses here. So the first witness is Fran Schneiderman.
Thank you, Chairman Wilson, members of the committee, for the opportunity to address this bill. Consumer Auto strongly supports the bill because we think the practice of charging, Marylanders with poorer credit ratings much higher rates for car insurance is really punishingly unfair to a lot of Marylanders, including low-income people, including people who have poor credit because of an economic hardship or reversal, including people with thin credit records, and including African American and Hispanic and immigrant households. Spatially neutral, but because African American households are much more likely to have lower credit ratings, it has a negative impact on African American and Hispanic households. The price gaps here are really big, $1,000, $1,500 or more for people with poorer credit. That goes way beyond what might be justifiable in terms of some marginal propensity to file more claims or some difficulty doing business with people who have a poor credit, poor history of making payments. Basing these things on credit rating reports is really problematic because credit reports are notoriously inaccurate. Consumer Reports did a survey showed that 34% of consumers found serious inaccuracies on their credit reports. And it's very hard to get and time consuming to get these things corrected. Also, we should have an insurance system that rewards safe driving practices rather than things like credit records that don't have an obvious relationship to your safety on the road. A number of states have banned the use of credit ratings, including big states like California, Massachusetts. The insurance folks will always tell us that there'd be chaos in the ratings and a lot of rate hikes if we prohibited them from using the credit ratings. I haven't seen any evidence that that has happened in states that have done that. And I hope
Mr. Schneiderman, I need you to wrap it up, bud. Def got a lot of witnesses, so you wrap it up for me.
Yes, no, I just wanted to say I hope maybe someone folks on the committee would ask if they have any evidence that the kind of impact on rates that they say will happen have actually happened in the states that have prohibited the use of credit. So we think it would be important for fairness and public safety to prohibit the use of credit ratings ask for a favorable report on the bill.
Thank you. Seeing no questions, I have Caleb Jasso.
Yes, thank you. Caleb Josso here with the Job Opportunities Task Force, an independent nonprofit organization that develops and advocates policies and programs to increase the skills, job opportunities, and incomes of low-skill, low-wage workers and job seekers in Maryland. JOTF supports House Bill 690 as a means to reduce discriminatory practices by insurers that result in disproportionately high auto insurance premiums and denials of coverage for individuals who are low income, have limited education, and lack access to opportunities that can generate high credit scores. Mobility is key in Maryland's regional economy. The Census Bureau reported that almost 50% of Marylanders travel outside of their county for employment. This statistic is more pronounced for lower income communities of color, where there's a scarcity of jobs available by public transit. The effects of using these non-driving factors, specifically credit history, results in extreme racial disparities into an auto insurance premiums and further perpetuates a cycle that many low-income workers are desperately trying to break. The use of non-driving factors effectively prices the majority of Maryland's low-income communities out of the insurance market. It is imperative that the unjust discriminative practice of insurers using an individual's credit history to determine coverage and premiums for auto insurance be eliminated. House Bill 690 seeks to ensure that low-income and low-skilled Marylanders are not unfairly denied coverage or saddled with high insurance premiums simply because they are poor. We respectfully urge the committee to issue a favorable report. My colleague, Senior Policy Advocate of JOTF, Christopher Dews, will also be testifying on this, on House Bill 436, and will answer any additional questions. Thank you.
Thank you also, Nicole Hanson-Mundell.
Good afternoon. Apologies for being in the car, and I really like the music that you all hold when folks are waiting, so I appreciate that. My testimony is clear. My colleague will give you all the data about why this is unfair. What my testimony today is that the temperature check on the ground is that we feel community folks who are impacted by these harsh policies around auto insurance feel that the only reason why Maryland has not moved on this issue is because of pay-to-play politics. We've seen this play out in efforts like the bail reform effort, where it took this body, this legislative body, decades to begin to move on bail reform in a way that felt equitable and felt fair. And it was a staggering report led by Common Cause Maryland that showed that the monies that were put into the accounts of our elected officials who were members of this General Assembly, and the monies and the pay-to-play trips and the ways in which the lobby uses its money to influence legislators was the reason why that reform was not moving. And so I fear that in this climate, that will be something that will be investigated, because that is the temperature check on the ground. That the reason why these things are not moving in this way is because the lobby is influencing our elected officials through campaign funds and through pay-to-play politics. And so that's my testimony today. And I hope that you all move on this in some kind of way. Thank you, Mr. Chair.
Yeah, I'm sure that you're not insinuating individuals aren't voting their conscience in this committee. I'd appreciate if you didn't. Obviously, individuals here take
Mr. Chair,
that.
I'm not insinuating that.
And I wasn't asking, ma'am. I'm saying, ma'am, I heard your testimony. I heard your testimony. I hope that you're not insinuating. Ma'am, I'm not trying to discuss.
Give the voice of the people. That is all.
And again, it's my turn to talk. You got your 2 minutes. I'm making it very clear that in case anybody listening confused it, because you're not the only one talking or the only one listening, that I hope it wasn't your intent, as you said it wasn't, to insinuate that anybody on this committee is taking money and selling their votes, because I know my colleagues better than that. I hope that we continue to testify on the subject matter of the bill at hand, not politics in Maryland or an emotion or a feeling that you have about the way things are being done, because our goal is to make good policy, not create arguments for political change. This is on the subject matter of this bill. Thank you.
Mr. Speaker, I'm not making those assumptions about anybody on this committee. My
Thank you
job
very
as an
much.
advocate
Thank
is
you
to
very much, ma'am,
report
please.
what the people
Ma'am,
are saying, and that is it.
Ma'am, thank you very much. I got you. Thank you. The next person to testify is Christopher Dukes. I apologize, Delegate Howard, you have a question?
Yeah, just real quick for Franz Schneiderman.
Please, go ahead.
Yeah, thanks. Just real quick. I mean, one of my concerns with this bill is that, they would use other weighted factors, like there are discounts for being in the military. There are some discounts for being an honor roll student when it comes to driving. And one of my concerns is that if you take away things like credit check, that would sort of make the insurance companies put a little bit more weight on things like military service. And as we know, not everybody can serve in the military. So, that's one of my concerns. And I'd just like to hear your rebuttal to that.
Well, nothing in this bill prohibits them from using things like military service or other facts. We're just trying to, I think certain kinds of factors like credit rating are deeply unfair to certain kinds of people, including low-income people, people with thin credit ratings, immigrants. And, the state has forbidden the use, say, of race and income levels in setting insurance rates because, the legislature recognizes that some of these factors are really the use of some of these factors really are unfair to large groups of people.
That being said, they can still use let's say, and again, I'm a military veteran, and so I'm just going to fall on that one. There's many other things that they could use to rate, but let's say they give me a discount for serving in the military or former military members discounts. Not everybody has the ability to serve in the military. Don't you think that would be unfair? It seems to me that this would put undue, weight on other factors, and that could be one of them, and it could be perceived as unfair by people who simply through some physical disability or mental disability aren't able to serve. And I think that's unfair. Maybe this is sort of spread out through military service and credit rating and some other factors to try to look at discounts that can be offered to people. So isn't that so, I guess? I mean,
it's not ideal from a fairness standpoint, in my view. If you could show me that people who with military service were, paying $1,000 or $1,500 less than the rest of the population, that would be a kind of discrimination that I would think would be worrisome. I see your point as a general matter. Specifically, there are certain kinds of discrimination that really seem to be burdensome that we're trying to limit here.
Thank you, Mr. Chair. Thank you, Mr. Snyderman.
Delegate Harrison.
Thank you. Question is for, I guess, either Delegate Wells or Mr. Schneiderman. Isn't it so that individuals who may be sort of starting over, and the two examples that come to mind is perhaps someone who has just gone through a divorce and has lost everything, or perhaps someone who's coming out of a domestic violence situation as they begin to try to put their life back together, could very well either not have credit or have bad credit because of whatever that issue may have been that could have been out of their control. Isn't it so that this is something that could possibly help an individual like that?
Absolutely. Yeah. It absolutely could, Delegate Harrison. And I think to that point, and kind of holding off with the previous question, I mean, I think this bill is just simply looking at, like, there are very relevant factors that we should be considering, and that credit score is not an indication of your driving record, and you should be basing it off of that. And especially, we know that folks that may be financially challenged, they have a record of paying as well, right? And so we're just simply saying, let's not overburden people who are working, going out of their way to pay for their car insurance. Let's not make it more difficult for them to successfully pay that insurance, especially if we know that their driving records are impeccable and that the only thing that's causing them to have a higher interest or higher premium rate is the fact that they have a low credit score, especially if they're like some of the folks you mentioned that are coming out of a costly divorce or, another hardship.
And I'd like
There are all
to
kinds
add,
of reasons.
I'd like
you.
to add that the 3 states that have done away with this, which is Michigan, Massachusetts, and Hawaii, have not had a significant problem when they started looking at driving histories and not credit histories as far as the insurance industry's risk assessment was concerned. So basically the sky didn't fall because they stopped looking at people's FICO scores and just focused only on their driving history, like we should do in Maryland.
Okay, thank you. Christopher Dews.
Fantastic. Members of the committee, my name is Christopher Dews, for the record, Senior Policy Advocate of the Job Opportunities Task Force. You've already heard my colleague speak because we thought that these 2 hearings were going to be separated. Should have known better than that. For us, this is, of course, an employment issue. We have come year after year after year trying to make changes to these non-driving factors, making auto insurance more affordable. But just to be clear, in case these numbers were not already salient to the members of the committee, 14.1% of Maryland's 4.3 million drivers drive uninsured. That means that over 602,000 drivers risk incarceration, as the delegate has already mentioned, mostly because they can't afford it. The uninsured rates in Montgomery County, Baltimore City, well, you know what, I'll take this piece for piece. In Baltimore City, it's 11.1%. Montgomery County, 11.5%. Baltimore County, 16%. Prince George's County, 22.8%. And it's only gotten worse since then. Those statistics were from 2015. We're talking about double. Consumer Federation of America found that it was double the cost simply looking at credit history alone. MPC has reported about this. Washington Post has reported about this. California, Hawaii, Massachusetts, and now Michigan have banned the use of credit history. Michigan took it a step forward and banned all non-driving factors, zip code, credit history, gender, everything else included. So this is not something that is unusual. I do want to mention one other piece of data though. Since 2015, 47,000 Marylanders have had fines statewide because they could not comply with basically having insurance. And lastly, in Baltimore City alone, but since 2017, 24 individuals have been incarcerated. This affects real people. We're trying to get more data and statistics to spread that out. But the bottom line is members of the community are now filing reports with the Maryland Insurance Administration and say that this is a problem. And it's something that the legislature should definitely look at. Last thing I'll say with my last second is that to Delegate Howard's point, my brother is also military, but he made the mistake of going to the military after he went to college. So he had a crap ton of student loan debt, which did affect his credit. So he had a hard time getting insurance as well. But I do thank the delegate for making that point. With that said, we ask for a favorable report.
Thank you. Next is Alina McWilliams.
Hi, my name's Elena McWilliams. I'm a policy and research staff over at Out for Justice. I'm here in support of my executive director, Nicole Hansen-Mundell, and also in support of House Bill 436. I'd like to point out that broadly, this practice exacerbates the cycle of poverty and the criminalization of poverty. People in poverty naturally have trouble paying their bills, which causes lower credit scores, which then raises their insurance premiums, which then lowers their monthly income and ability to pay their bills, which means they might ultimately be driving without insurance and then possibly get pulled over and even incarcerated due to lack of insurance. And if that happens, they are out of the workforce and their income goes down and the cycle continues. Furthermore, the law prohibits the explicit use of race to determine insurance. However, the use of credit scores circumvents this protection. over 50% of white households have a credit score over 700, while only 21% of Black households do. That disparity is clearly linked to a myriad of economic barriers historically and presently faced by Black Marylanders. A research report by PayScale found that after 55 years after the passage of the Civil Rights Act, we find equal pay for equal work is still not a reality. Black Marylanders are likely to receive harsh, Black Marylanders and Black people across the United States are still getting paid less for equal work. And so they are likely to have lower income and face harsher credit score issues. With those facts in mind, it's no wonder that some scholars have referred to this practice of using credit scores for insurance as the new modern day form of redlining. So we urge, given everything everybody else has said, we urge the committee to have a favorable report on House Bill 436.
Delegate Howard.
Thank you, Mr. Chair. Just real quick for Mr. Dews, you said that the numbers that you quoted for, or cited, I'm sorry, for Prince George, Montgomery, and some counties throughout Maryland and jurisdictions throughout Maryland were for 2015, but the numbers are worse.
Yes.
Where
So,
can I?
wait,
Yeah, where
let him
where
ask
can
the
I
question
find that
first, please.
information? I'm in front of my computer on Google. Where can I find that information?
great. First of all, thank you for that question. Now, that information came from the Maryland Maryland Auto Insurance Fund. So you're gonna have to piece the data together here. So the information I just quoted on the uninsured stats comes from an MVA study that was done in 2015. I want to be very clear, that was prior to the pandemic, of course, right? Al Redmer, the head of MAIF, mentioned just last year, February the 11th of 2021, that the number of uninsured has increased by 20,000 people. Now, he mentioned that, and that was, of course, after the 2020 study that stated that 12.4% of Marylanders were uninsured. So I want to be very clear, just to put it all together. I think the numbers from 2017, it was 12.6% drive uninsured, okay, in the state of Maryland. Now we're talking about in 2021, the Insurance Information Institute has said that 14.1% of Marylanders are now driving uninsured. So we're seeing an increase from 2017, which is the numbers from the Insurance Research Council, to 2021, which is numbers from the Insurance Information Institute. So by that kind of logic, you're going to see an increase in the amount of people that are driving uninsured. Does that make sense?
I'll talk to Commissioner Redmer. It also seems to me that the logic would lend to the fact that a lot of people have lost their jobs and that they're probably let some of their insurance go by the wayside because of it too. And it's not specifically due to credit-based insurance rating, but I'll get to the bottom of it. I thank you for your answer.
Thank you. Delegate Blair.
Yeah, it's for Mr. Dews and Ms. McWilliams. You both quoted a lot of different statistics from a lot of different sources. Could you send all those statistics and sources to me so I can review them? Because it'd be much easier to understand them in the context that they're made rather than the context of your testimony, because you can only do so much testimony, but it would be nice to actually read where these are coming from, who's making them, to help us make our decision. So I'd be happy if you could send them to me. Thank you.
Thank you very much. Absolutely. Thanks.
Next person we have is Isadora Stern.
Yes, hello, Mr. Chair, members of the committee. My name is Isadora Stern, here with the Maryland Consumer Rights Coalition. MCRC is a statewide nonprofit that works to advance economic equity through research, direct service, education, and advocacy. And we're here in strong support of HB 436 and HB 690. Preventing auto insurance companies from using credit history and rate filings is a matter of economic and racial equity and of public safety. The MIA prohibits the use of race and income, but it allows other factors like credit that act as proxies. Someone's credit history says a lot about what financial opportunities and hardships a person has been presented with, but it says nothing about how a person drives. If I missed a credit card payment for whatever reason and took a hit to my credit score, would that transfer to a decrease in my driving ability? It wouldn't. Auto insurance companies should not be allowed to use non-driving related factors that have nothing to do with a person's ability to drive, and are better indicators of race and income, which are the factors that they are not allowed to use. This is a matter of economic and racial equity, and it's also a matter of public safety. According to a Consumer Reports study, a Maryland driver with an excellent credit score, but with a DUI, will pay $1,600 less than a driver with poor credit but a perfect driving record. These are the wrong incentives. When someone with a poor credit history pays more than someone with a DUI, it's a policy problem and it's a matter of public safety. Auto insurance companies have the power to reward good drivers and disincentivize reckless driving. But right now they're rewarding more dangerous drivers with lower premium costs that they're subsidizing with the higher premium costs of safer drivers. Maryland already has banned the use of credit in setting home insurance rates because it was found to be discriminatory. We need to do the same for auto insurance. We need good policy that protects drivers, especially from discrimination when purchasing a state mandated product. Thank you for your time, and I urge a favorable report.
Thank you very much. We go on to Robert Enton.
Thank you very much, Mr. Chairman. Members of the committee, Robert Enton on behalf of the American Property Casualty Insurers Association. The legislation, which is the subject of today's bill hearing, was passed back in 2002. The bill went through the House Economic Matters Committee and the Senate Finance Committee, and the law that you have on the books today was a compromise. That compromise provided that in the state of Maryland, credit could be considered, but subject to tremendous limitations. Part of the reason for the compromise was that all the data which was presented demonstrated that credit was a predictor of loss. And that's what every study which has been done since then has shown. It is a predictor of loss. Under Maryland law today, insurers are prohibited from engaging in any unfair discrimination in underwriting. They can't cancel or refuse to underwrite or renew a risk wholly or partly based on race, color, creed, sex, or blindness of the applicant, or for any arbitrary, capricious, or unfairly discriminatory means. So I think the answer is that if someone believes that the use of credit is unfairly discriminatory, they would have the basis to go to the insurance commissioner and file a complaint. To my knowledge, that has never happened. I know my time is limited, so I just want to point out one or two other things. The other witnesses can talk about the limitations under Maryland law. Every study that's looked at this has shown that if you eliminate the use of credit, 50% of all policyholders will see an increase in their premium. Roughly 18% will see a decrease, almost 3 to 1. And 32% would probably see no change whatsoever. When you look at what the Maryland law provides compared to other states, we go far, far beyond the other 46 states that have no limitations whatsoever on the use of credit. For those reasons, Mr. Chairman, we'd urge the committee to give the bill an unfavorable report, or the bills. Thank you.
And Bob, we have quite a few questions popping up, and I just wanted to first, and maybe we'll hear it from somebody else, because we hear these bills every year. And what I hear from the insurance is that, hey, but this is how we do things because we agreed to do them this way in 2002. You've heard the young lady say that a person with a DUI has pays less than a person with poor credit. So what I think the frustration, the ongoing and continuing frustration with members of my committee are, we're almost being told by the insurance companies like, yeah, but that's the way we do things. And like the young lady said about redlining, that was the way they did things then until they were told not to. Our job as policymakers, what I would like to hear from the insurance, and you said it, so hopefully you'll provide this evidence, is that whole 50% increase overall. Because what I keep hearing almost every hearing is, yeah, but that's the way we do it. And that's becoming unacceptable, as you're going to hear, I'm assuming, from the hands that have popped up. But I just want to say that wasn't a question. That's an observation. Delegate Harrison.
Thank you. And mine is just a very simple yes or no question for Mr. Enton. Is a DUI considered a risk? Yes
They look
or
at
no?
the over.
Yeah,
Well,
yes
I
or
can't
no?
say. Sure.
Well, I
considered a
can.
risk.
as an insurance broker, a DUI, I think is considered a risk. Thank you very
Yeah,
much.
I agree. I agree.
Okay, Delegate Walker.
Thank you, Mr. Chair. And I almost want like a straightforward answer. I'm looking at the fiscal note and what I see here. So the first question is a yes or no. Right now, are insurance companies using credit score for giving out rates? Yes or no?
Yes. Yes.
Okay. So if that's the case, do we know, and as an African-American legislator in a district that's majority minority, then why would I sit here and even listen to what you have to say? We know that African-Americans typically and minorities have lower credit scores. You know, I'm fighting so hard to get financial literacy taught in the schools, that's a fault of ours. But if we know that, then how can we sit here with a straight face and say, you know what, this is okay. It's an acceptable practice.
I don't know that the statement, and I'd be glad to go back to my clients and ask that, you know, that there's data that I'm aware of that says that the lack of a low credit score is related to race.
Well, come on, man. Okay.
Once again, I don't know, but I would only say to you, Delegate Walker.
I said it as a brother. I said it as a black man. Okay, so
I'll say believe that's the case, then it would seem to me that a complaint ought to be filed with the MIA and an allegation made that it's unfairly discriminatory, and that has never happened.
That's trying to make it cloudy, Mr. N. That's trying to make it cloudy, because if you're not astute enough to have a better credit score, then I'm pretty sure you're not astute enough to figure out how to weed through the Maryland insurance agency industry to find out who you complain to, or even know that this is something that you're eligible to do. So last one before I go on the soapbox is, so I heard, I believe it was one of the bill sponsors or somebody that spoke and said, the other states that have done it and the sky is not falling.
I know that there are 3 other states that have banned the use of credit completely. 46 states allow credit without limitation.
Has the sky fallen in those 3 states that have done it?
I don't know that. I'd be happy to get back to you with that.
And Mr. Chair, just to submit again.
Wait, nope.
Yeah,
that's not how we do things in the committee, bud. If there's a question asked to you as presenter, I got you. Otherwise, that's not how this works. Go ahead, Delegate Walker.
Yeah, so all I'm gonna say in closing, you know, I've heard this long enough. The simplest thing to do is to say what these delegates have come up with, and the people since I've been here on this committee have done before. We shouldn't be using credit as a basis for driving. Period, point blank. That's a statement. Thank you, Mr. Chair, for letting me rant a little bit, but come on, man.
Apparently, everybody in this committee is going to do it at least a few times. Delegate Queen.
Thank you, Mr. Chairman. Hi, Mr. Enton. How are you?
I'm fine, Delegate Queen. Yourself?
Fine. I just want to clarify. I think I heard you say that credit score is used as a proxy for predicting loss. So it's a proxy for the likelihood someone would make a claim.
No, let me say it's not a proxy for it. It is one factor which statistically is very, very clear, and every study says it. A Federal Trade Commission, state studies say that it is a predictor of loss. Most companies have 75 different rating factors that they use. Under Maryland law, let me just, if I could just say one thing, under Maryland law that deals with credit, you cannot refuse to write a policy, or you cannot cancel, go ahead and refuse to underwrite, cancel, or refuse to renew a policy based on credit. We have limitations on the extent to which it can be used. It's a very, very limited application, but it is a factor that can be considered along with other factors. But if you apply for a policy with my company, I cannot refuse to underwrite it based on credit. That's part of the law. I can't refuse to renew it. But I can't increase your premium because your credit score went down once I've given you a policy. But if I'm going to take you in as a new policy holder, I can look at it along with other factors to see what's the appropriate rate.
Okay. May I ask a question now?
Please.
All right.
I'm sorry.
So it's credit rating is a factor, one of many factors to predict loss, the likelihood that I may make a claim.
Exactly.
That is different from the likelihood that I may have an accident, or I'm a risky driver, correct?
The studies show that credit impacts the likelihood of loss. Yes.
Likelihood of loss doesn't say I'm a bad driver, correct?
No.
Right. So since it is not a factor on my ability to drive, it's not a risk factor on my ability to drive, and you have other factors that can predict loss, why do I need it?
I think because it is a
Why do I need it?
Statistically and actuarially, it is a
Don't
valid
talk about actuarial stuff
predictor.
with a mathematician now. Why do I need it?
I think we have used it, and 46 other states use it because it is an accurate predictor of loss, and that's what we base our premiums on.
One of many, and you have others you can use. Thank you
We
very
have others
much.
we can. Okay.
Thank you. And again, Delegate Jalisi, go ahead and put your hand down, bud, because you're a presenter. You don't get to ask questions. Delegate Howard.
Thank you, Mr. Chair. To the individual that testified that we're no longer using credit-based rating for home insurance, is that your testimony?
Yes, I said that, and that's
Okay.
correct.
That's
Okay.
true.
Bob.
Yes.
And now, just very quickly, let me switch to you. Is that because of the 1975 Home Mortgage Disclosure Act, which specifically is federally mandates that the collection of race information? Is that why Maryland?
That was part of the original compromise that was reached in 2002.
So in an effort
was to ban it on homeowners, but to allow it under limited circumstances for auto.
Because they're specifically collecting race data per the 1975 Mortgage Home Disclosure Act. So insurance companies in Maryland specifically got away from this because that data could be accessed.
I don't know that.
I would love to find out. If you could find out, that'd be fantastic.
Sure. Could I just say one thing about the homeowners?
We gotta wait.
Okay, sorry.
We don't have time for all the representation. We've got Nancy Egan.
Thank you. Nancy?
Go ahead, Nancy. I just saw her on here.
Hi, sorry, my apologies. I'm just trying to unmute and get going here. Nancy Egan with the American Property Casualty Insurance Association. We write 50.9% of the private passenger marketplace. We obviously are also in opposition. We feel that the risk-based pricing system that we have in place is fair. We use a wide variety of objective data that is proven to accurately predict an individual's likely of suffering an insured loss. I know one of the delegates said the word claim. No, it is a loss, that you will experience a loss in the future. It has built one of the most competitive marketplaces for the US, and the best bet for any consumer is to shop around. The MIA just published on their website the Auto Insurance Comparison Guide of Auto Rates as of February 2022. It prices 60 of the top insurance carriers in 22 different rating scenarios in 6 different rating territories. So I ask you all to go to that as a reference. Maryland has a very strong and competitive marketplace. There's over 140 auto insurers in Maryland. One indicator is the share of MAIF in Maryland. It was 6.3% back in 2002, 1.17% in 2015. And as of 2020 NAIC data, it shows that they are less than 0.5% of the total marketplace, and their policy count is decreasing. The fact that we are writing more and more people out of MAIF into the competitive marketplace is well for everyone. I want to go back to some other questions. What happens when a state bans credit? We did ban credit for auto back in 2002. And what did that mean? The rates for homeowner rates went up faster than the rest of the country. 53% rate increase from 2002 to 2007 in Maryland versus 36% nationwide. In addition, someone asked about the use of no credit. The Maryland law is pretty specific about that. If a person does not have a credit risk, it can't be used against them. In addition, Maryland law provides that every 2 years, the insurance company must review your credit scoring. And if it improves, they must improve your rate for credit scoring. So there is a system in place. They cannot surcharge you for if your credit goes down, but they can improve your credit as it goes along. And just last year, we
Nancy,
looked at this bill.
I got to cut you short, ma'am. I know we'll have a few questions. Bob.
Okay, I will, and can talk about the extraordinary life circumstances that was discussed last year. I'm welcome to any questions. Thank you.
And before we go, I guess I have a question. So let's say I'm going through a divorce. So my credit's horrible. It gets bad. 2 years, I'm still going back through this, losing property, things of that nature. I don't get into a single accident. Under what you're explaining, I will still be paying more, although I'm a good driver.
Okay, first of all, we don't look at your income, address, ethnicity, religion, gender, family status, national origin, occupation, or whatever.
That was not what I asked.
Yes.
My example.
As I mentioned, your credit score can be reviewed every 2 years and upon request by the person, the driver.
But I guess I should ask it again, because I didn't ask that. What I asked is,
I understand what you're asking. Let's say you have a bad life circumstance in case of something that happened in your life.
Correct.
You can reach out to your insurance company and ask them to make a consideration. In fact, last year, we amended the law. We amended the bill in House Economics. I think you all remember Chairman Davis talking about this because people were concerned about things that were happening during the coronavirus pandemic. We asked to put into place the NCOIL model about extraordinary life circumstances. The bill was amended last year to provide that a consumer could request their insurer to make reasonable exceptions for such things as serious illness, injury, death of a spouse, divorce, involuntary interruption of legally owned alimony, identity theft, or loss of employment.
Wait. You're giving me extraordinarily long answers for very short questions. But all that to say, if you heard the young lady before, when I got a little bit on the upset side, because she was talking about basically payouts and things of that nature. See, when we're asking these questions and we're not getting sufficient answers, it's hard to blame her for thinking that somebody must be on the take if we're still allowing these things to happen, when you've heard the good delegates and all the answers were, because if I'm going through a divorce, you know what I'm not doing? I'm not calling my insurance company too. I'm dealing with the drama of that. And I guess what we're trying to understand is there are a multitude of reasons. You got 75 factors. Why do you need this one too? We understand why maybe where you live matters, because of the crime that you have in your neighborhood and the value of the vehicles in your neighborhood. There are things that we get where claims are more than they're not. We get all that. We understand that it's a lot cheaper to get earthquake insurance on the East Coast, where there are very few earthquakes, than it is on the West Coast. We get that. But the problem is citizens don't understand the predictors that you're using. So we end up looking like the bad guy when we're told by your people, hey, just take our word for it, it's good. Because we had to fight you guys to get the marital status taken out a few years ago because they were punishing people whose spouse died. So we've been doing this a while, and I think it's frustrating because as much as I seem to be frustrated at the presenter, I was frustrated with the situation she was painting. She's a citizen. She has the right to feel that way. We're the ones that look bad when we get no sufficient answers about why this is so important, with the same argument you guys use for why marital status was important. And it sounds like we're getting the same thing over and over again, and nobody understands how credit relates beyond the same way, honestly, race could relate to filing. Sex could relate to whether you're going to file or not, because that's all those could correlate. But I think that's where we're stuck at, is you're not giving us any good, true reason that our people would understand. And we are the people's house. So when a young lady thinks that we're on the pay, which is why these things aren't being done correctly, that is very bothersome to me, to have a hearing where we can't walk away explaining, hey, you guys, this is why credit history is important. So please, in presentations, please explain to me why credit history is so important when you've heard everything that say why it shouldn't be.
would you like me to respond, Chairman?
That,
Wilson?
please explain why credit history is so important.
I appreciate that. Thank you so much. I could go through the very details of predicting loss and how being able to have a.
I don't mind. I don't mind.
Okay.
At this point, I would like to hear your rationale so we can take something back to our people if you indeed want us to kill this bill.
Thank you very much. Rating, the understanding of rating is that our product is a little bit different than a product that you buy, like a Coca-Cola. When you buy a Coca-Cola, you know the cost of the ingredients that go into buying the Coca-Cola and you know how to price it. Auto insurance isn't that way. We need to predict in the future how many claims are going to happen by the drivers, how many losses are going to happen. And the more accurately we can predict which drivers are going to have losses, the more better that we can assume more risk in the marketplace. The more money that we can free up to maybe write some risk, which we considered maybe something we wouldn't have written in the past. So the more likely and more predictive we can use these factors to determine our rates and individualize cost for drivers, the better is for the overall loss experience for future losses and lowers the rate. We have found that credit scoring has been one of the most accurate predictive of losses, which is why we've been using it. That's why we've included in the studies that I've included in my testimony, and I can't speak for others, about the losses and how it predicts the future. Maryland law is very strict. We actually limit the percentage that a company can surcharge or credit or provide a credit for credit. It does not do that for any of the other risks. It just does that for credit. So it is limited in the state of Maryland, which is not done in other states. I know that we've heard, for example, Massachusetts does not use credit in that state. And yet I heard from Mr. Schneiderman that it didn't have an impact. I would like to point out that in Maryland, we have 140 companies writing auto insurance. That means there's a whole marketplace out there, which is why I asked you to go to the MIA website. But in Massachusetts, when I checked 4 years ago, I don't have the data today and I can find it for you. There was only 30 companies in that state providing auto insurance. I think that's a big difference. It means that in Maryland, we have a myriad of choices to choose from to price our auto premiums versus Massachusetts, which has put some strict restrictions in place. So that's why we feel that the credit being such a predictive of loss with the restrictions. And I will say again that last year we were very much in favorable of putting in the legislation about extraordinary life circumstances, so that if someone is impacted by divorce or a death in the family or illness or loss of a job, that it would be put in and that it could be not used when determining credit. So I hope that provided you some of an answer for you, Chairman Wilson.
We'll go on to Delegate Charkoudian.
Thank you, Mr. Chair. I think my question is sort of a follow-up on the chairman's and on Delegate Queen's question. You said it predicts loss, not claims. So I'm just wondering what your distinction is there. And let me just see if I can say it in my words, and if I have this right. Loss would equal claims times the amount you have to pay out. Is that right?
I'm sorry, I'm saying that when I think last year when we discussed this, we talked about claim versus loss, and you were saying that people with better credit don't put in claims. I think that was your argument last year. And I think what we need to think about is when you hit another car, you're the driver and you're insured with, I don't know, MAFE, and you hit someone that's insured with Progressive, okay? The person at Progressive that you hit is going to expect you to file a claim. This is what we're talking about. This is a loss. So I don't know how a person that you hit, you're not going to put the claim in. Is that what you're saying? I don't understand it because that's a loss and that's what we're trying to predict. And I think that you will hear from some other people that'll talk about some other statistics that they've used about the likelihood of losses based on driving behavior. But this is the discussion that we continue to have.
It is, and I think that we all know that we have gotten into accidents ourselves, and sometimes if we have been in a position where we've had extra cash and been able to pay $250, then we would do that rather than going through the hassle and having our insurance rates go up. And if we don't have access to that $250, $500, then we file a claim and then we end up paying it back with higher insurance rates. So I think that we all understand from our personal experiences that people, especially in smaller accidents, make the choice about whether or not to access the insurance they've been paying into. And so what we're struggling with is it seems that accessing a claim leads to loss, and the connection that we can see, because I've asked for the data showing the connection between credit rating and driving, and I got some charts. I asked more questions. I got more charts. My questions never got answered. I'm still not accepting that there's a connection between credit rating and driving. So the only connection I can see that makes intuitive sense is that someone who struggles more with finances, thus has a worse credit score, would be more likely to need to tap into and use the insurance that they're paying for than someone who maybe has the extra cash on hand and doesn't want to go through the insurance company. So that makes a lot of sense to me. And until somebody can present some other connection between those two things, I'm going to continue to believe that using the credit score is discriminatory against poor people, and then all of the other connections that has to racial inequity and everything else. So that's really my question. I've been asking the same question. Many of us are asking the same question, and I think we're not feeling like we're getting a clear answer that is the connection between credit score and something other than I need to use my insurance that I've been paying for.
I guess I don't want to belabor the point, and I ask you just to look at my written testimony. There is a chart where there's a correlation between risky driving behavior and credit score. You'll see it. It's in, I think, the second or third page, and I do ask you to look at that. It has to do with people that brake excessively and their credit scores. It's their sense of risk. So I just send you there, and I think Delegate that someone follow me is going to discuss that risky driving behavior and perhaps could answer your question better.
With all due respect, if that's the chart, I'm going to look at it in a second, but if that's the chart that I've seen before that Bryson and I went through last year, that chart doesn't connect credit score to braking behavior. That chart connects the pool that credit score is used in. And so it's sort of a self-fulfilling prophecy, because you're using credit score and you already told me it's only a small percentage that it's limited to. You're right in the mix of your factors. And so it's using a set of factors that credit score is one of and connecting that to braking. So I don't know what else is in that mix, and you can't tell me what else is in that mix because of the bill that we heard a couple of weeks ago that's a trade secret. And so it's this kind of self-fulfilling, you never actually have to give us the transparent data. Isn't that so? Thanks for indulging me, Mr. Chair.
Thank you, Delegate Jackson.
Thanks, Mr. Vice Chair. Is Mr. Enton still on? Doesn't seem like it. Well, maybe, yeah. Well, my question was for him, actually. He had made a statement.
He's not in here.
Okay, maybe Miss Egan can answer this question.
Thank you.
Yeah, so Mr. Enton mentioned that 50%, that rates would go up 50% for motorists if credit scores are not used. Do you know what was the source of that claim? Or
I don't think, I think he was talking about the percentage of people that would be impacted, not that the rates would go up 50%, Delegate Jackson. I think if you look on the last page of, second to last page, there was a study done by the Maryland Insurance Administration back in 2019 that pointed out the use of the credit would result in a premium increase for substantially more policyholders than those that would have a premium decrease. So I think they pegged it at 75%, but I did reference that in my on page 13, in my footnote 13. If you could look at that, it talks about how many consumers would be impacted in Maryland if credit would be eliminated. So that's just the reference I would send you to.
All right, thank you.
Thank you, Matt Overturf.
Good afternoon, Mr. Chair, Vice Chair, members of the committee. My name is Matt Overturf on behalf of the National Association of Mutual Insurance Companies. NAMIC is the largest, nation's largest trade association with more than 1,500 members, 22 of which domiciled in Maryland. NAMIC requests an unfavorable report on House Bill 436 and House Bill 690. As we've heard, credit-based insurance scoring is one of the many factors used by insurers to assess risk and price insurance coverage more accurately. The scores help insurers more fairly assess the risk and offer the most competitive rates possible for drivers. Because House Bill 436 and House Bill 690 would prohibit the use of this rating factor, NAMIC requests an unfavorable report on both bills. Thank you.
Thank you, Bryson Popham.
Thank you, Mr. Vice Chair, members of the committee. Bryson Popham appearing before you in opposition to this legislation on behalf of Progressive Insurance, Agency Insurance Company, the Maryland Association of Mutual Insurance Companies, and the insurance agents and brokers. I've appeared many years since 2002, and I was in the debate. I was in the State House on sine die in 2002 when this law was originally passed. It has survived remarkably intact. And as is often the case when I listen to other witnesses, I'm changing my testimony, and I'm going to go straight to the point that Delegate Charkoudian made and also was referred to by the chairman earlier. I would direct the committee's attention to an attachment to my written testimony. That attachment is under the heading of credit-based insurance scores tell us a lot about how someone drives. You have it in your packets. It's an American Property Casualty Insurance Association document, but that document to which Delegate Charkoudian referred is included in this one. And to sum it up, there is a direct correlation, a 98% plus correlation between credit-based insurance scores and several risky driving behaviors. One of them is hard braking. Another of them is hard acceleration. Another of them is handheld cell phone use. And there are others as well. I can't think of a better way to answer the chairman's earlier question. Tell us what we can tell people about why credit should be retained. These are actual examples. Now, you may ask yourself, how is it that we know these things? And that's because one of my clients and a number of other insurers engage in the use of telematics, and that's what measures this risky behavior. So they drew the correlation, the analogy here. The charts are there for you. Delegate Charkoudian, I'm happy to have another conversation with you if you wish. If I need to get more information for you, I shall. And any other committee member that wishes to have a fuller explanation of this, I'm happy to do my best to provide it to you. Thank you, Mr. Vice Chair. We respectfully request an unfavorable report.
Thank you, Delegate Charkoudian.
Thank you, Mr. Vice Chair. What I see is variable A correlates with variable B, and a separate chart that says variable C correlates with variable B. And you are concluding that variable A correlates with variable C. And that's just not how it works. It may or may not correlate, but that's not how it works. So I'm happy to have a conversation about these charts with you again, but I still, been asking for this for a few years, and I do think it's a really important thing to be able to articulate to the chair's point. And I'll just leave it at that. We can follow up. Thank you.
Thank you, Delegate Queen. Yep, I got you.
Vice Chair. Yeah, sorry, I had to come off of this thing. Thank you, Mr. Vice Chair. Just have one comment, Mr. Popham, because you mentioned the telematics and some of the things that they're finding. So did you realize that root insurance that uses telematics has recently said we should drop credit scoring from insurance policy. That is something recently.
I'm sorry, Delegate Queen, could you repeat that question? I couldn't hear you.
Sure, you mentioned about the telematics that are used as to why you are looking at using credit scores, and Root Insurance, which uses telematics, talks to the fact that we should drop credit scores. It's a recent article by them. So I just wanted to let you know that.
Well, I was aware of that, Delegate Queen, and I respect Root's position, but why should everybody adopt their particular rating plan if there are other plans that work? Why should we?
Understood, but you mentioned the use of telematics, and they are a major they're a major user of telematics, and that's, I just wanted to let you know that that was mentioned, so everyone else would know that as well.
Thank you, Delegate Queen.
Thank you. And that concludes the bill hearings on House Bill 436 as well as 690. Next, we'll go to Delegate Carey. He has 3 bills in a row. The first one is House Bill 587.
Thank you, Mr. Vice Chairman. Good afternoon. Good afternoon, committee members. For the record, Ned Carey here to present House Bill 587. House Bill 587 would regulate and provide consumer protections in the sale of motor vehicle financial protection products in the state. A motor vehicle financial protection products are optional agreements that protect the consumer's financial interest in his or her car. The most common example of a motor vehicle financial product is the debt cancellation agreement, which is also referred to as a gap waiver. This is an optional product for consumers who finance the purchase of a car. As we all know, as soon as we drive off the dealer's lot in a new car, the car value drops. And if you financed your car and your debt is greater than the value of your car, so for a period of time, if that car is totaled or stolen, you will or probably owe more than you'll get from the insurance company. But under the debt cancellation agreement or the gap waiver, the amount that you would owe in excess of the insurance proceeds are waived. But without the gap waiver, you would be left owing the lender for a car that you no longer have on top of whatever you need to pay to get a replacement car. So as I mentioned, this is an optional product and you may choose to assume that risk, but for those that want to protect themselves against financial risk of being underwater on a car following a total loss, a gap waiver is an option. But for many years, Maryland law has allowed the debt cancellation agreements to be offered and financed along with cars under the Retail Installment Sales Act and the Close-End Consumer Credit Act in the commercial law article. However, those laws contain no regulation over debt cancellation agreements themselves or consumer protections as to how they're offered to ensure that consumers know what they are purchasing. House Bill 587 fills this void in current Maryland law. House Bill 587 would also cover similar products that protect a consumer's financial interest in a car, including an excess wear and use waiver, which is a similar product to the gap waiver, but it's used when you lease a vehicle. And if purchased, all or part of any amounts that become due under the lease for excessive mileage or wear and use of the leased vehicle would be canceled or waived. The other is the Vehicle Value Protection Agreement, and such as a trade-in credit agreement or other similar agreements, they're also covered in this Vehicle Value Protection Agreement. For all of these products, the bill ensures consumers maintain the right to change their mind. It requires that consumers are given a 30-day free look period where a consumer can change his or her mind after the purchase without any costs, fees, or penalties. In addition, the consumer protection it provides for are as follows. Number one, a requirement of a variety of disclosures beforehand that ensures that the consumers know what they are purchasing. Number two, financial responsibility requirements to make sure that the companies backing these agreements have the financial capacity to perform them. And number three, enforcement provisions and potential fines for violations under the regulation of the Maryland Insurance Administration. I would just close by saying that we've been meeting with the Maryland Insurance Administration and the Consumer Protection Division in the Attorney General's office And we're aware of the issues that they have raised on the bill, and we look forward to continuing to work with them on this so that the General Assembly can move forward to adding this regulatory and consumer protection framework to Maryland law. So with that, I would respectfully request a favorable report with the amendment to House Bill 587. And Mr. Chair, I have my committee with me, which is Marta Harding and Mr. Aaron Lunt, and they will be able to provide any additional detail and help answer any questions. So if I could proceed with them, we could
Yep,
speed.
Delegate, no issues, and they're actually the only two signed up on the bill, period.
That's correct.
So, okay, Marta Harding.
Thank you, Mr. Vice Chair. For the record, Marta Harding. I'm here on behalf of the Guaranteed Asset Protection Alliance, GAPA for short. As Delegate Carey said, Aaron Lunt is also here, who is with GAPA, and he is here at my request to testify on this bill. I want to express our sincere thanks to Delegate Carey for putting in what we think is a really important bill. You have our written statement, so I'm not going to read from that or repeat anything. I really want to just focus on a couple of big picture things that I think need to be sort of borne in mind on this bill. And Delegate Carey hit on some of these, but I think they're just so important. I want to emphasize, and that is that these products are not new. They're being sold every day. As Delegate Carey said, the current Maryland law explicitly allows debt cancellation agreements to be sold and to be financed right along with the car. But the only thing Maryland law says is you just have to separately state it. You have to do it as a separate line item in the finance agreement. So they're being sold without any of the protections that Delegate Carey just mentioned. You know, the disclosure requirements so the consumer understands what they're getting, the ability to change your mind after the fact, the financial responsibility requirements on the providers, the enforcement within a regulator that can go after a company if they're not complying with the law. Maryland is actually one of only kind of a handful of states, less than a dozen, that don't regulate these types of agreements. States, in large part follow the model that is in this bill and that we would like to see the General Assembly move forward with. I want to just say, as Delegate Carey said, we have been meeting with the MIA and the Consumer Protection Division. We believe that they've raised issues that we're happy to work with them on, and we look forward to that. But we do think that ultimately it is very important for Maryland to join the majority of the other states that have chosen to regulate in this form. And for those reasons, we would request that the General Assembly look favorably on this bill. Thank you very much.
Thank you, Aaron Lunt.
Yes, thank you so much for the opportunity here. Thank you to the chairman and members of this committee. My name is Aaron Lunt, and I'm here on behalf of the Guaranteed Asset Protection Alliance, as Marta just alluded to. We are here in support of this piece of legislation. As Marta referenced, we have model legislation in approximately 25 other jurisdictions and are pursuing legislation in a myriad of other states, including this state in Maryland. We think this is a necessary piece of legislation that will provide a few things to the marketplace and to consumers. First, we think this is a very pro-consumer piece of legislation. We are asking for regulation and legislation in this perspective because we think there's adequate consumer protections that will be built into the law that is good for Maryland consumers. Two, we think it adds clarity to market participants as to what they can and cannot do to successfully sell a compliant product in the marketplace. Three, and perhaps most importantly, it will help exclude bad actors in the marketplace. Good actors in the marketplace, which is a lot of the companies that we represent, administrators, insurance companies, gap providers, they want the bad actors out of the marketplace because they dictate high volumes of complaint to the Maryland Insurance Administration and other consumer groups within the state. And we want to get rid of the bad actors so that there's clarity in the rules of the road so that the good actors can stay compliant and do what they need to do to meet consumer and customer demand. And then lastly, Marta alluded to this, it gives enforcement tools to the regulator so that they can effectively go after those bad actors and enforce consumer protections. We are actively working with the MIA to socialize this bill and get them comfortable with it. And we're here to answer any questions that you might have. So thank you for the opportunity to testify, and we do support this piece of legislation. Thank you.
Thank you, sir. Seeing no questions, that concludes the hearing for House Bill 587. We'll now go to House Bill 563. Delegate Carey.
Thank you, Mr. Vice Chairman, and good afternoon to the members of the committee. Again, for the record, Ned Carey here to present House Bill 563, surplus lines brokers. House Bill 563 is entitled Insurance Surplus Lines Broker Policy Fees, and it addresses the fees charged by surplus lines brokers. Surplus lines brokers are licensed to place coverage for Maryland insurance consumers with eligible non-admitted insurers when those risks are unable to be placed in the standard market insurer and are often unable to write risk due to the fact that they're new, unique, or especially high capacity. In those cases, an insurance agent is permitted to seek coverage through a surplus lines broker and place that business with a non-admitted insurer, similar like Lloyd's of London, for example. This bill, with the amendments provided in your packet, would allow surplus lines insurance brokers to charge a commercial insured for placing a surplus lines risk a fee of either $250 or up to 10% of the surplus lines premium, whichever is greater. The current law caps the fee at $250. Additionally, the amendments codify the current understanding that for commercial exempt policyholders, a surplus lines broker may charge a reasonable fee for placing such risk. And with that, Mr. Chair, I will ask the committee for a favorable, and I have my panel members, Brett Leininger and John Meets, to provide more details and help answer any questions. Although my understanding is Mr. Meets is probably not on the screen. I think he might be in the air flying to get here to talk to us on the Zoom. So it probably will just be me and Mr. Brett Leininger.
Yeah, I don't see him on here either, Delegate Carey. So we'll go to Brett Leininger.
Mr. Chair, can you hear me okay?
You were a little broken up. Go ahead, keep going.
Okay, Brett Leininger here on behalf of the Wholesale and Specialty Insurance Association. Thank you to Delegate Carey for sponsoring the legislation. Did a great summary of the bill. Just to give some context, the surplus lines market is kind of the safety valve for the insurance market. So you have the standard market is unable to provide coverage for certain risks that are considered special risks, just fall outside of the bucket of the standard market. This legislation, sponsors amendments, there was some confusion in bill drafting, but with the sponsors amendment only applies to commercial business, so business to business only. And there are tasks that the surplus lines broker who places this business in the surplus lines market that they're required to do statutorily, which are outlined in the one pager that's provided. It says, why is a policy fee charged? For the sake of time, I'll just direct you to that, some of their requirements. The legislation, so yesterday actually had a good history lesson from Mr. Popham about when the caps were put on about 25 years ago. There apparently was no cap in Maryland until the Maryland Insurance Administration told the industry that in order to be able to charge a fee for their services, it has to be referenced within 27-216, which is the subject of this legislation. So the cap of $250 has been in there since that time. What we're looking to do, there are 45 states that have no cap at all. We're not aware that there's any problem with charge of unreasonable fees. Looking to say $250, or in the amendment as drafted says, or 10%, it should say up to 10%, just so committee council knows. And that would be able to let the market dictate what's an appropriate fee to charge. Nobody's going to be able to just charge anything. And within 45 states, Maryland is one of the most restrictive, but 45 have no caps at all. And with that, we urge a favorable report.
Thank you. We'll now go to favorable with amendments. Bryson Popham. You're on mute, sir.
Thank you, Mr. Vice Chair, members of the committee. Bryson Popham on behalf of the insurance agents and brokers appearing in support of this legislation with a suggested amendment. My compliments to Delegate Carey for introducing this and to Mr. Leininger for presenting the bill. I was there 25 years ago when this legislation went in, and I do agree that it's past time probably to revisit the issue of surplus line policy fees. Surplus lines brokers provide necessary services for which they are not compensated as part of the commission of the policy. That's why they are allowed to charge fees, and those fees are earned. So there's no objection on the part of my clients, who are the retail agents that deal with the surplus lines brokers, to the charging of policy fees. My only suggestion, Delegate Carey and members of the committee, is that there should be some upper limit on the amount of the fee that can be charged other than the 10% premium limitation. We respectfully suggested yesterday increasing the cap to $500. I would say, whatever seems to be reasonable would be appropriate. And I certainly believe that Mr. Leininger's clients would not abuse the ability under this bill to increase policy fees, but there would be the possibility of others out there who could. Why is that important? Because surplus lines insurance, by definition, is available from a limited number of insurers, not regulated by the Insurance Administration, and there isn't as competitive a market as there is in the admitted market. So with that, Mr. Vice Chair and members of the committee and Delegate Carey, we respectfully request a favorable report with an amendment. Thank you.
Thank you. Seeing no questions, that concludes the hearing on House Bill 563. We'll now go to House Bill 637. Delegate Carey.
Thank you, Mr. Vice Chair, members of the committee. For the record, Ned Carey here to introduce House Bill 637. It's Title Insurance Producers Annual Review. So let me just briefly take you through this. Thank you for the opportunity to share with you House Bill 637. This legislation allows a title insurer to conduct an annual insurance producer review at the place of the business of the title insurance producer, remotely using mail, overnight delivery, or electronic means, or through a combination of both on-site and remote methods. This process was used during the 2020 and 2021 in the pandemic under the executive order without any reduction in the quality or results of the reviews. The Maryland Land Title Association, Title Insurers Coalition, and the Maryland Insurance Administration have agreed to amend the bill which you have to require the report to be submitted on the MIA to the MIA on a form created by the commissioner. The Senate Finance Committee voted on the bill's cross-file favorable with this amendment. And I would just like to point out that I will get to the committee. I just received a letter from the Maryland Insurance Commission in support of this bill. So at this point, I'd be happy to answer any questions, but Mr. Chair, I have Bill O'Connell and Ted Rogers, who are my panel, and they're our only two witnesses on this bill, I believe.
Yep, that's it. Two witnesses total. So we'll go to Bill O'Connell first.
Thank you. Good afternoon. My name is Bill O'Connell. I am an underwriter for First American Title Insurance Company, who is a member of the Title Insurers Coalition. I applaud the commissioner for her responsiveness to the title insurance industry in a time of crisis and her willingness to adopt the title insurance to adjust the title insurance producer review process in light of what we learned from it. When the pandemic hit, there was much confusion and consternation in the industry concerning in-person on-site reviews of title insurance producers by the title insurers whose policies they issued. Early on, the commissioner was responsive to the predicament that the title insurers and title producers were placed as a result of the pandemic. But before allowing remote reviews, the commissioner required each title insurer to prepare and submit a plan for how the reviews would be completed. After reviewing each plan, the commissioner allowed remote reviews to proceed. After almost 2 years of completing the reviews remotely, the commissioner and the industry have learned that conducting the review remotely has not resulted in any decrease in their effectiveness or thoroughness. Title insurers take these reviews very seriously, probably more so than the commissioner. This is a good bill and will serve Maryland well in the future. I'm always looking for silver linings. This bill is a silver lining to the chaos caused by the pandemic. As such, we ask for a favorable report on HB 673. Thank you.
Thank you. Ted Rogers.
Thank you, Chairman. Thank you, committee members. Good afternoon. I'm Ted Rogers, president of the Security Title Guarantee Corporation of Baltimore, Maryland's only domestic title insurance underwriter. I'm speaking to you today on behalf of the Maryland Land Title Administration Association in support of HB 637. As Delegate Carey said, during the pandemic, the Maryland Insurance Administration issued an emergency order allowing annual reviews to be conducted remotely for health and safety reasons. And as Mr. O'Connell said, we applaud them for that. Because those reviews were conducted without any diminution in quality, the administration supported an amendment to Article 10-121 that would remove the on-site requirement introduced today by Delegate Carey as HB 637. This bill will reduce costs while continuing to provide the same high degree of oversight the title insurers operating in this state are already required to provide over their producer agents. In subsequent discussions with the administration, however, they proposed and we support an amendment to HB 637 that is intended to codify their authority to create a standard form for reporting violations of insurance statutes by appending to the end of Section K3 of this bill the words "in a form and format created by the Commissioner." For these reasons, we ask for a favorable vote on HB 637 as amended. Thank you.
Thank you, sir. And seeing no questions, that concludes the bill hearing for today. Members, just a reminder, Monday is alcohol day and those hearings start at 1 p.m. Thank you, everybody, and have a great day.